Saurabh, good morning. Good to have you with us here. Saurabh has been circumspect while people were cheerleading the rally all the way to 9,000, and I suspect that the skepticism hasn't gone away. Saurabh, where do you stand now? The markets lost about 24% from the highs, 7% last week alone. Have we gotten into some kind of a not value zone, but or you think no stability yet? Market should go a lot lower from here. Where are we now?
So I think, Prashant, I think the bulk of the correction is done, but I think it's premature to say that the market's bottomed out. My reckoning is the Sensex will bottom out somewhere between 20 to 22,000 I think this will happen over the next 6-7 months. But I think the more important question is, leaving aside the question of where is the bottom, the question is there any reason to believe that over the next 12 months there'll be a strong rally in the Sensex? And that's where my reckoning is. It's difficult to see that. It's difficult to see grounds for believing that there'll be a strong rally. The pain in the banking system, as we all now know, is quite profound. I don't think the pain is somehow going to dissipate in FY17. I think FY17 will also be a painful year for the banking system. The fisc is constrained. We know the fiscal challenges. I think it's reasonably evident now that we will see a degree of fiscal slippage vis-a-vis the 3.5% target for FY17 that the FM had promised a year ago. And if you look outside, India, leaving aside the grim situation back at home, if you look outside India, it's not evident that the Chinese government has found a solution to the structural woes of the Chinese manufacturing sector, or indeed the Japanese government or the European Union have found a solution. So you've got deflationary pressures, powerful deflationary pressures, which threaten to wreck banking systems in big Western economies, the Japanese economy, and those deflationary pressures are not going to go away in a hurry. So the global construct has been challenging, still remains challenging. Domestic concerns of the banking system will, I think, persist quite significantly through the next financial year, and the government's fiscal position, in spite of the windfall gains from the oil conk-off, the fiscal position, I think, is quite difficult. So I don't sort of see a reason to believe that there is some imminent rally in the Sensex, and hence no reason to believe that people watching this program should suddenly jump into the market with both feet.
Just a very simple question to you, Saurabh. At a time when there is by some estimates, some $8 trillion of global debt trading at negative yields, what's so wrong about buying, decent, good quality businesses offering yields of, 4, 5, 6, 7%, if not higher? I mean, is there even a choice?
So I think, Prashant, it's not so much the absolute level of yield which sort of determines a debt investor's behavior. The level has some role to play, but the big driver of FII debt investors' behavior is their perception of which way the yield will move. And if you look at the Indian 10-year government bond yield, given the rising signs of fiscal slippage and the rising CPI prints now, it's not evident that the 10-year bond yield will come down. And if the 10-year bond yield doesn't come down, the chance for FII debt investors to make significant investment returns on buying Indian government debt obviously abate. And that's why I think the budget is actually a big event for the debt market, because if this budget is a meaningful slippage, last year the government sort of froze the fiscal consolidation journey by saying that for a year we'll freeze the fiscal consolidation. If this year they sort of not just freeze the fiscal consolidation journey, actually turn the clock back and say 3.5 becomes 3.9% or 4%, I think that'll really spook the FII debt investor. And I think there's around 35, perhaps $40 billion of FII debt in the country, and there's a potential selling around that after the budget. The hardening of the 10-year bond yield and the pressure on the currency is actually my bigger concern, as opposed to what might happen in equity markets, on issues like CGT and so on. Those are sort of concerns, but my primary concern is how will the FII debt investor perceive the sort of increasing fiscal slippage that is evident in India's fiscal construct.
Mm-hmm. No, I was talking about, I'm just giving the contrast here. Not debt, I mean foreign debt to local debt, but at a time when yields, I mean, investors are hungry for yield, right? Returns. So I was just giving you the contrast between, say, even stocks which are offering attractive yields. It could be banks, it could be other businesses, compared to such a low return yield environment around the world, much of the developed world.
Yeah, but if you adjust for a couple of things, Prashant, the sort of the relative attractiveness of stocks, Indian stocks dissipates. So let's first look at it from the FII's perspective. Our currency over the last 20 years has depreciated by 6% per annum. I think in the last 6 months alone, the rupee has gone from 62 to 68 to the dollar, and there's reasonable grounds to believe the rupee will depreciate going forward. So for an FII investor who's sort of looking at his returns in dollar-denominated terms, it's not evident that there is a great chance to make meaningful upside in buying Indian stocks, because the FX downside seems quite meaningful. Now look at it from the perspective of a FII debt investor. The FII debt investor not only has to reckon with foreign currency losses there, but also has to reckon with the bond yield hardening and hence losses on capital gains losses. And finally, let's come to the domestic high net worth investor. The domestic high net worth investor has been an enthusiastic participant in the stock market through all of 2015. Mutual flows into domestic mutual funds were roughly $1 billion a month, the best flows we've seen in domestic MFs for a while. Clearly those flows are drying up. They're drying up because investors are not getting a return from the market. Now, I would love domestic high net worth investors to take the long view and invest in equities when they are cheap with a 3-5 year horizon. But it's not easy for a 65-year-old retired pensioner to take the long view on Indian equities. And on the short view, the last 12-month view and the next 12-month view, it's not evident that there's a great story to be told around Indian equities. Hence, domestic mutual fund flows are drying up, which in turn makes it harder for domestic mutual funds to put money in the domestic market. That domestic support has dissipated, which is why we are seeing the market bake off in the manner it has conked off in the last 12 months. So this has been my fear since March last year. July, we up the level of concern by saying 22,000 Sensex becomes a high probability event. And now that we are reasonably close to 22,000 Sensex, my suggestion to investors out there is focus on capital preservation. It's not evident to me with whatever data I have access to that there's a great rally waiting to happen in the Sensex. So focus on capital preservation. If you don't have to invest in the market, don't invest in the market. If you have a compulsion to invest in the market, then look at what we call good and clean stocks, well-run companies, strong cash flows, strong balance sheets. That would be the only way to invest in what is, I think, a very dicey economy with a fairly fragile banking system and an increasingly frayed fiscal construct.
Okay. Fair enough. So just one specific point. One is hearing that there might be some tinkering done with capital gains tax exemptions for stocks in the budget. Are you hearing same things? I mean, I've heard exemption being removed, threshold for claiming the exemption being changed from 1 year to 3 years. I mean, do these look credible to you?
Look, I've read the same newspaper articles you would have read on the subject, and it's hard for me to opine one way or the other. The amounts of money the fisc will raise from such a measure are not going to be meaningful. I doubt the fisc will get more than 3,000, 4,000 crores from extending the CGT exemption period from 1 year to 3 years. But the damage to India's credibility as a market to invest in, not just damage from an FII perspective. If the FII obviously will lose some of his faith in the Indian taxation construct with such an arbitrary change in tax, but also the domestic high net worth investor, his faith in the sanctity of the tax structure around CGT will also be dented. So I'm not so sure what the cost benefit, how the cost benefit analysis stacks up here for the FIS, because the amounts of money they'll raise are modest, and the dent to India's credibility, the Indian stock market's credibility, will be fairly modest, will be fairly significant, and hence from a cost benefit analysis, I don't know why this sort of measure will be mooted. But I'm reading the same newspaper articles highlighting the risk of such a measure, which to my mind sounds fairly counterproductive.
You're talking about removing the exemption or changing the threshold? I'm assuming the former, not the latter. The latter wouldn't do that much damage, or will that be equally damaging?
No, so what we have read in the papers is that in order to get CGT exemption, you have to hold stocks for 3 years rather than 1. That will be damaging. The amounts of money that will raise are modest, and it will dent investor confidence, both foreign and domestic investor confidence in the Indian stock market. Not so much because high net worth individuals and FIs have some profound issue with paying CGT. What they'll have an issue with is with the arbitrariness of it all. There's nothing that this government has said or done in the past, either in its election manifesto or thereafter, which suggests that suddenly they will say that you need to hold stocks for 3 years rather than 1 to get CGT exemption, and to suddenly on 29th February change the rules of the game will feel to most people as unfair. So if the government wants to tax capital and tax CGT more aggressively, then they need to moot that, discuss that through in a public forum, and then move ahead with it. To do so out of the blue in the budget, which strikes me as a little odd. So as I said, I don't know whether this is actually being seriously discussed in Delhi. I've read the same newspaper articles as everybody else has. The reason I'm concerned it sort of feels quite a retrograde measure, because the costs appear to me to outweigh the very modest benefits, the very modest tax collections that will arise from such a measure.
Okay, fair enough. Saurabh, just to look at the slightly bigger picture, so foreign investors are still sellers, local funds are getting lesser and lesser money. January was the lowest inflow into equity mutual funds since the government took charge. On the flow side, we'll find out when the Feb figures come, we'll find out what's the picture, how bad is it getting in terms of flows into local funds. But on the foreign side, what are you picking up, what is happening? And is that likely to change at all, or no? It'll be the slow withdrawal over a period of time.
The pressure on our clients is assets under management is fairly relentless. This has been there for the last 8-9 months. FII clients of ours are seeing redemptions from their clients, and that pressure is fairly relentless. I don't see any abatement. If it's any comfort, this is not just an India-specific issue. Global emerging market funds are also facing redemptions. But the last 2 to 3 months, even India specialist, single country funds as they call it, India-focused funds are also seeing redemptions. There's no improvement on that front.
At the start of this year and late last year, many were of the view that after such a large underperformance over a 4-5 year period of EMs versus developed markets, we could finally be at an inflection point, that things could somehow change. It seems very unlikely that will happen. I guess the commodity collapse is one big reason why that seems very unlikely now.
I think it's yes, we've lived in hope for a while about EM recovery, but it's partly the commodity collapse, which in turn is linked to the profound problems in China, and it's also the structural issues that the West faces, West plus Japan faces in terms of stimulating an economic recovery. Just this morning, Japan is reporting minus 1.25 in their latest GDP print. As we know, the Japanese 10-year bond yield went into negative territory last week. So you've got structural problems in big global economies like China, Japan, the European Union, America is having a sort of tentative recovery. It's very difficult for EM to flourish in that sort of world. There's no sort of logical reason why somehow India will stand out as some oasis of safety, as is often claimed by establishment figures in our country. There's no logical reason why India will stand out as an oasis of safety in a world facing problems on multiple fronts, not just in developed world markets, but also in the largest EM, which is China. So part of what we are seeing is a global issue, but I think what makes it that much more serious for us is specific issues to India. The banking system challenge that we face is reasonably specific to India. It's not as if foreigners are to blame for our banking system's woes. Now, China also has a beleaguered banking system, but the fisc there has enough money to recapitalize the banking system. In our country, it's not evident that the fisc actually has the financial means to recapitalize the banking system. So unless the government comes up with some other construct, largely around using foreign money to recapitalize a banking system, it's not clear how we move forward as an economy. You can't really move forward when 3/4 of your banking system is clogged up with stressed assets. So that remains a core issue which is specific to India. The inability of our fisc to get consolidated, given the enormous windfall we've had from oil, is another concern specific to India. So had we had a domestic economy which was in fine fettle, we might just have been able to hold our heads up in the global turmoil. But our domestic economy, our domestic construct, banking, fiscal, is just as challenged as the global piece, which obviously means that the overall environment for equity investing simply isn't there.
What is in your good and clean portfolio, Saurabh, now? Have you made a fair bit of changes?
So we need compliance sign-off to discuss these. So basis the compliance sign-offs I've got, there's two stocks that we've been highlighting for a long time actually. TVS Motors, I think I've been advocating that for the best part of 4 years in my TV broadcasts, and our view remains that at 16 times earnings, this is a well-run company. They've launched Victor, 110cc bike a month ago. They've launched Apache, which is a 200cc bike a fortnight ago, and then there's a 310cc bike that they'll launch in a JV with BMW later this year. 3 credible launches in a year at a time when their largest domestic competitors simply aren't coming up with credible launches suggests to me that TVS will continue seeing market share improvements, and its operating margin, which is modest 7% compared to the high teens operating margins that the larger domestic 2W companies post, that operating margin I think has meaningful scope for improvement over a 3-year horizon. So credible company, good balance sheet, cash flows are coming through, market share gains are coming through. Top line has been growing at 20-25%, and if you ally that with a bit of operating margin improvement, you should see 35% earnings compounding. And that for a stock which is trading at 16 times earnings, I think makes this quite an attractive investment in the current circumstances. The second stock we've been advocating for a good year and a half is PI Industries. And our view remains that with 60-70% of the business coming from the international chemical companies, the buyers, the Dow Chemicals, the Syngentas of the world, PI remains a credible play on the custom synthesis and manufacturing construct, wherein an Indian company supplies chemicals to global majors on long-term contracts. PI's cash generation is strong, balance sheet is in good shape. The stock has come off a little bit over the last 2-3 months on indifferent results, but I've far greater confidence in this company's earnings and revenue outlook than most others, given the long-term contracts they have with the global chemical majors. PI is a little expensive, I think 23 times forward, but given the 35% earnings compounding we've seen in this over the last 4-5 years, I think our belief is it makes sense to look at PI. So you can see how I've been thinking about this. Difficult economy, difficult circumstances in our country, focus on quality companies, believable accounts, credible cash flows, strong balance sheet. If you invest in those and are reasonably patient, you might be able to preserve your capital in these uncertain times.
Saurabh, thank you very much. I understand you've got to run. Thank you for your time and perspective.